Swayam Prabha. Digital India. Educated India.
Welcome dear students. Today we discuss the financial instruments, how much important in establishment of a sound economy, or how to deal with the financial instruments and what is the compliance requirement to issue the financial instruments and types of financial instruments. I am Dr. Jaswant Saini, Associate Professor, Faculty of Law, MD, University Rohtak, present before you this topic. And as usual, we start with the learning outcomes. What we learn from this discussion, we gain the knowledge about the diverse range of financial instruments used in corporate finance. And without these instruments, it is impossible for us to arrange the corporate finance. And it is very difficult for a company to run their business without arrange the money through these instruments. So, secondly, we acquire the insights into how global integration has influenced the corporate fundings. Corporate funding is a important concept here. How we arrange this corporate funding and what type of purpose served by corporate fundings, these all things we discuss in detail here. And thirdly, learners will learn about innovative financing solutions such as securitized assets, venture capital and alternative investment funds. The various type of funds are available in the market and how much they are relevant for a company and how they serve the fruitful purpose, these all things we discuss in detail. Fourthly, learners will gain a comprehensive understanding of the dynamics within the field of corporate finance. Corporate finance is a finance of the corporate entity, and without this finance, it is not possible to run the business or be helpful here with this finance to the shareholders to enhance their value, their claims in the form of securities. Securities buy by the shareholders with the intention to earn more and more funds, with the intention to earn more money from this investment. And this investment serve the fruitful purpose if the importance of the money lies in the eyes of corporate entity, and corporate entity enhance the value of these claims, financial instruments or the invested money with the help of establish their goodwill in the market. And with the more and more market cap of their securities, if a company establish their reputation in the market, no doubt the value of their securities much enhanced, much increase, and that is also become the example for others in this competitive market. In this competitive era, everyone need to be enhance the value of their securities, and in this direction they will be treated as torch bearer whose names established in this corporate arena as a leaders. If results of your company is on higher side, you become the example for others. So, what is financial instrument? Financial instruments are assets. Basically, every instrument is a asset that can be traded. So, few words we try to understand here, how they are important in the establishment of good economy or good reputation or goodwill in the market, or they can also be seen as assets that may be traded. So, one thing is here, every instrument is an asset. Second, those instruments should be traded. Traded here means that is marketable lots in the form of the liquidity established through these trade items. Marketable item, traded items, that indicate that these securities are selling, buying allowed in the market. Financial instruments provides a gateway for the flow of capital to investors all around the world. Basic thing reflected behind this one, that is a gateway, that is the entry point. If you buy the securities, this security is helpful to enhance the value, and this security is helpful to establish the flow of capital in the market, and investors invested their money, their hard savings in the market with the intention to earn more money. So, all around the world, this is the main feature behind the investment. The flow of capital is the main reason behind the investment. Second, if this money increase with the increase of the value of the investors, investors value increase with their investment, and investment related with the decision of investors, and that is the well settled principle of business law. And every business community must ensure that their investor must be in safe hands. Safe hands here means expert group of persons apply this money in rightful direction, and this is the gateway to enter in this scenario, to invest your money with the intention to earn more money. Financial instruments are documents that may be real or virtual and represent a legal agreement involving any kind of monetary value. Basically, these instruments prove that there is an agreement between two, debtor and investors. In real sense, they are not known as debtor. Basically, they are corporate entities. They invite the investors, and investors, if agree with the terms which reflected in the prospectus, they apply the money for earn more money. So, this type of investment governed by the law of contract, and that amounts to legal agreement between these two persons. One is corporate personality, that is a company. Second, who invests their money in the companies, and that investment may be a real, may be virtual. So, that is immaterial thing, either that is a real investment or the virtual investment, but that represents the legal agreement between the parties. Secondly, that is a document. Every instrument is denominated in some value, and that represent the documents, that is resulted in the feature of some documents. And another feature of these instruments, they are equally applicable as a law, because that amounts to legal agreement, that deems to be legal agreement, and the monetary value also reflected in these instruments, either in the form of numbers, either in the form of value. So, according to the nature of these documents, that is reflected either the number of documents in number or either in the value. Financial instruments can be in the form of a contractual rights. Here we use word legal agreement, here we use word contractual rights. So, contractual rights are such rights which governed by law of contract, and once you invest in any company through these instruments, contractual rights arise being an investor, and delivery or receiving cash or any other type of financial claims. Documents basically establish either your claims, either that's resulted in assets. If in clear cut direction not given as an asset, that's resulted in claims. You may be claim this amount later on or on any future date. So, this particular assets establish that you invest the money and your rights reflected by contractual rights, categorized as a contractual rights, and you govern by law of contract when you invest your hard savings in any company through these financial instruments. Types of financial instruments, here various types of financial instruments we discuss in this entire discussion. Financial instruments basically divided into two types. One is cash instrument and another is derivative instruments. Cash instruments are such instruments whose values reflected in cash. Cash is the main object here and directly influenced and determined by the market. These securities are easily transferable. Basically, that is the characteristics of every company here. Their securities are easily transferable from one hand to another hand without fulfill the complex formalities. So, if these facilities provided in any instrument, that is automatically a traded instrument, that automatically categorized as a marketable instruments. So, in cash that is reflected here and easily transferable facilities are here. Stocks and bonds are common example of such instruments. Stocks and bonds. The basic difference between share and stock. Share always reflected or denominated in numbers. Stock always denominated in value. So, share and stocks and bonds are the common example of such instruments. Otherwise, every type of instruments where there is an claim of the money established, where there is a contractual right established, that amounts to instruments. Cash instruments may also be deposits and loans agreed upon by borrowers and lenders. So, again we are coming on this point, there are two parties, one is borrower, another is lender. If they agree on certain points, that is automatically converted into agreement, and agreement if fulfills some conditions, that amounts to contract. Checks are the best example in this direction. Checks is a cash instrument because they transmit payment from one bank to another bank, one bank account to another bank account. Sometimes in the same bank you may be transfer the money from one account to another account. So, that is not a material thing. Important thing is here transfer of money from one hand to another hand, and this is possible through the nature of these checks. And derivative instruments, the value and characteristics, derivative instruments are based on the underlying securities such as assets, interest rates or indices. These are the examples. And the very set example here, if someone open their locker in the bank and he deposit there, or you say procure there some ornaments, and the key in the hands of whom, that is the owner of this locker, and he open the locker as and when required. The value of this key, not the real value of the key, but the value of the key reflected with the value of the ornaments available in the locker. So, value of the key on the basis of underlying securities which available in the locker. So, that is the very set example in this direction for derivative instruments. if the value of the articles we derive from the underlying securities, that is the derivative instruments. So, there can be over the counter for derivatives or exchange traded derivatives. OTC is a market or process whereby securities which are not listed on formal exchanges are priced and traded. So, derivative instruments deals in some exchanges which establish for this specific purpose. So, we are not going in detail here what derivative instruments, but we discuss here for the purpose of categorization. The instruments categorized in two categories, one is cash instrument, another is derivative instrument. So, type of asset classes of financial instruments: equity based financial instruments, debt based financial instruments and foreign exchange instruments. They are the some classes here we discuss in detail. Equity based financial instruments are those which represent ownership of an asset. Common stock, preferred stock and convertible debentures are some of the prominent examples of an equity based financial instruments. Where there is an money involved in these instruments, that is related with the equity, that is related with the investment in shares. So, that type of instruments known as equity based financial instruments, where there is in real sense the equity shares are involved. So, debt based financial instruments are those which represent the loans made by an investor to the owner of assets. Bonds, certificates and debentures are the example of debt based financial instruments. Debt based financial instrument basically establish that there is a loan given to the company by individual or by the corporate entity. Banks, financial institutions or corporate creditors provide the loan to the industries, and when individual provide the loan to the industry, that is provide in the form of debenture. When in corporate capacity they provide the loan, that is known as borrowings, credit or loans. So, that is the some example of debt based financial instruments. And another type is here foreign exchange instruments. There is a trading platform where one currency is traded with another one. It means there is currency is not same, one currency to another currency, these instruments change. The transaction associated with foreign exchange, and this foreign exchange take place in the foreign exchange market, which is also known as the forex market. Currency futures, currency swaps and currency options are some examples of foreign exchange instruments. And in our India, where there is any involvement of the foreign currency or foreign exchange, that is deal by FEMA. Foreign Exchange Management Act 1999 deal with the same, and enforcement director deals such transactions if they found any fraud in such transaction where there is an foreign currency involved. So, foreign exchange instrument is also one of the way to invest the money in such way. Sources of corporate funding. Corporate funding is the area of finance dealing with the sources of funding and the capital structure. Sources of funding and capital structure of corporations. The actions that managers take to increase the value of the firm to the shareholder. This particular word increase the value of the firms to the shareholders, and the tools and analysis used to allocate financial resources. So, from very beginning we are concentrate on this point here, decisions decisions play very important role in the financial market, and financial instrument basically represent the investment plan of a investor. And when investor decide to invest their money in any institution, first he take the decision, and before take this decision he analyze the entire situation. So, sources of funding through these instruments, basically these are the instruments to manage the capital structure of the corporation. In this word of corporation, every type of business include here. The actions that managers take to increase the value of the firm to the shareholder. Value of the investment of the shareholders if increase, that's become a symbol that the faith of the shareholders establish in the market, and faith of the investors establish in the particular enterprises, particular corporation, particular business. And tools and analysis are play a very important role in this arrangement of money, in this capital structure, or to establish the financial resources for any business. So, particular decisions play a very important role in this direction. Capital market of any economy act as an axis of economic development. No doubt, economic development of any country based on establishment of sound financial market, and sound financial market always based on two ingredients, two components, two elements. One of them is here financial instrument, second liquidity. If more and more available in the market, that leads to introduce new instruments in the market. That leads to establish the faith of the investor in the market. Once a faith established in the market of the investors, then there is no lack of funds in the market. Market full by funds once a faith of the investors established in the market. And in this direction, you no doubt establish that financial instruments play a very important role. And once a market established, it means a sound economy established of the country. So, basic axis or the axis of economic development governed by instrument and market liquidity. So, as it ensures supply of capital from the savers to investors through various forms of financial instruments. Money available in the hands of whom? Money available in the hands of investors. And money required to whom? Money required to the industry. And this money transfer industry, this money transfer from there to this hand only if there is a financial instruments are strong and there is the faith of the investors. Then they never hesitate to supply the capital to such industries who establish their name in the market. So, no doubt we establish here one conclusion, two basic components if serve their purpose in the market, that resulted in sound financial market, and sound financial market if once established, it means good economy always established there. And our country no doubt nowadays in first 5 economy of the world, and this first 5 economy we establish through the faith of the investor in the market. Mainly there are two kinds of financial assets through which investors can invest in capital market. One is equity, second is debt. Equity basically those who apply their money in equity, they are the owner. Who apply their money in the market as a debt, they are the creditor. They provide the loan to the company. And owners always entitled for dividend if company earn the profit in any financial year. But creditors are always entitled for interest. Even the company not earn the profit in any financial year, they always entitled for the amount of interest. So, equity would mean the money provided by shareholders without any repayment clause or charge creation on the assets. They are the investor and there is no any intention behind this investment for repayment, and there is no any intention to earn as a interest against this amount. In comparison of this one, in the debt, the intention reflected in another way. Their reflection is here, money should be in the safe side and there is a interest earning on this money. Repayment clause is there and security of the loan is also there, and the high finance cost is applicable where there is a debt money, and there is a cheap finance cost applicable where there is an equity based money is there. In India, the debt market comprises mainly of two segments. One is government securities market consisting of central government, state government and zero coupon bonds, floating rate bonds and treasury bills, and corporate securities market consisting of financial institution bonds, public sector undertaking bonds and debentures and corporate bonds. So, basically this debt market we divide into two categories, one led by the government securities, another led by the private securities. In government security, basically the guarantee of the exchequer, guarantee of the government regarding repayment of the amount. But in case of corporate securities, there is no any such guarantee of the exchequer or the government. There is a guarantee of the charge, if charge created against these securities. So, we discussed this concept of charge in the chapter of debenture in detail. So, various examples of financial instruments we discuss here. Very first is here share certificate, and that relates to share capital of the company. A company can issue two types of share, one is equity shares, another is preferential shares. Equity shareholders are considered as owner of the company, and in comparison of equity and preferential shares, preferential shareholders are given preference at two times to own their shares. Very first at the time of dividend. At the time of dividend, first right given to the preferential shareholder. At the time of winding up, first right to participate in the assets of the company in the hands of preferential shareholders. Equity shareholders are also known as ordinary shares, and they are considered as owner of the company in real sense. While preferential shareholders enjoy the benefit of receiving their dividend distribution first, and equity shareholders enjoy voting right in each and every matter. Every issue put before the equity shareholders for vote, and they decide the policies in the light of well settled law, in the light of equity, in the light of well settled principles of business law. So, voting rights are available only to the equity shareholders. Preferential shareholders are allowed to cast their vote in one circumstances, if company failed to give the dividend to their preferential shareholders in last two preceding years, then they are considered as equivalent to equity shareholders. Then they cast their vote on each and every matter. Otherwise, preferential shareholders are allowed to cast their vote only on such matters which related to their preferential natures. So, the preferential shares are most commonly issued by the companies to institutions. For example, here banks and financial institution, they try to enjoy this right on their investment. When they ready to invest, they invest with a condition that dividend right first and participate in assets first at the time of winding up. The primary market is the avenue of resources, mobilization and capital formation. Through this primary market, we establish the capital structure of a company. It deals with the issue of new instruments. When any instruments company decide to issue, that issue through this primary market. And corporate sectors such as equity share, preferential shares and debt instrument, it means primary market is basically when company itself issue the securities and you not buy the securities through the route of stock exchange. Company itself issue the securities, that activity is known as activity of primary market. Nowadays, if the size of issue is more than 100 crore, then it is a compulsory every company follow the book building process. That is also one of the form to issue the securities in primary market, and nowadays this is a well established practice. Every company issue the securities if they cross the limit of issue size, that is 100 crore, through the book building process. So, various type of issues in the capital market for corporate finance are initial public offer, FPO further public offer, right issue, preferential allotment and bonus issue. So, these are the ways to arrange the money for the company as a capital. So, IPO is the famous way when first time company issue the securities, and when other than first time issue, that is known as FPO, further public offer. Right issue means when company only decide to issue their securities to the existing shareholders, and preferential allotment and bonus issue also some forms of issue the securities with different features. So, debt instrument, right issue means when company offer the securities to their existing members. Preferential allotment, we already know that generally issue to the institutions, and institutions generally prefer to buy the preferential allotment. And bonus issue means without cash, when you issue to your existing member, sometime you benefited your existing members through this bonus issue, and this bonus issue never in lieu of dividend possible or allowed. And debt instrument market is the market for issuance of trading and settlement of various types of features of fixed income securities. Debenture is the example here. Debenture being an important source of funding is a long term debt instrument issued by corporate and government. These debentures are available in both sides. Government also issue these securities and the private players also issue these securities to secure fresh funds or debt capital for the purpose of company. Debenture is a document which evidencing a debt or acknowledging it, and any document which fulfills either of these conditions is a debenture. It means this is like a evidence company take loan from individuals. It contains a contract of payment and repayments on specific date with the interest that is applicable, and there is a contractual obligations applicable between the parties when someone buy the debenture. So, on the regular interval you if enjoy the payment with the interest, that is the main feature of this debt instrument, or you may be say debenture. And various types of debentures here. One is secured debenture, and this type of debentures basically enjoy the feature of debentures where charge is created on the assets of the company. Mostly immovable properties are charged for the purpose of payment in case of default. Charge is the term only used for debentures or the loans, and charge is basically a security that's ensure that payment should be made by the company on specific date. Unsecured debentures are such debentures where there is no any charge create against the property of the company, and company assets are free from any charge. Interest rate payable on unsecured debentures is generally on higher side. If your secured debentures, the interest rate may be on lower side. If your debentures are unsecured debentures, interest rate may be on higher side. So, redeemable debentures are those which are payable on the expiry of the specific period, and maximum period fixed by the regulators for redeemable debentures, that's maximum period is here 10 years. No any company allowed to issue the debentures beyond this period. From the date of issue, either in lump sum or in installments during the lifetime of the company. It means company ensure that payment will be made back to the holder of these debentures on specific date, and this date may not exceed 10 years. Bonds is also one of the type of the debt loan or the debt instruments, or that is the arrangement of capital in the form of debt capital. A bond is a debt instrument in which an investor loans money to a corporate entity which borrows the fund for a defined period of time at a variable or fixed interest rate. That's depend on the nature of the bonds. Either the variable rates are applicable, either the fixed rates are applicable on these bonds. Bond is also certified the payment schedule based on the maturity period. Generally bonds are paid on the maturity period, and bonds are referred to as bills or short term bonds and long term bonds. Both type of bonds are available in the market. Generally infrastructure companies when issue the bonds, these bonds are long term bonds, and if the maturity period less than 36 months, that is considered as short term bonds. Bonds have a fixed value, face value, which is the amount to be returned to the investor upon maturity of the bonds. So, maturity of the bonds is on specific date, that is the main feature of these bonds, and face value is always fixed on the bonds or generally fixed on the bonds. During this period, the investor receive a regular payment of interest either biannual basis or annual basis, which is calculated as a certain percentage of the face value. Both type of features available in the bonds, either you take the interest on regular interval or either you take the interest on the date of maturity. So, such type of bonds known as coupon payments, when the calculated as a certain percentage on face value. Government bonds, these are the bonds issued by the central government, state governments or public sector undertakings. These bonds are secured as they are backed by the security from the government. Government gave the guarantee for payment of these bonds. Corporate bonds, these are the bonds issued by the private sector. Indian corporates have issued secured as well as non-secured bonds. They generally offer high interest rate in comparison of government bonds. Banks and other financial institutional bonds, these bonds are issued by banks or other financial institutions, development banks or other financial institutions who establish to provide the credit facility to the corporate sector. Tax saving bonds, there is the important area where there is an you invest in bonds to save your tax. Nowadays, when India governed two regimes of income tax, one regime where there are deductions are available and another regime is applicable where there is no any deduction, lump sum tax paid to the government as an income tax, but they vary here rate of calculation of tax. How you calculate the tax and rate of taxes are different. In case of deductions are available, the higher rate is applicable. In case of no any deduction available, there is a different type of slabs, 5%, 10%, 15, 20, 25, 30. It means that is the only country all over world where there is a two regimes are applicable. Alternate investment fund, that is also one of the instrument where fund established or incorporated in India, which is a privately pooled investment vehicle which collects funds from high net worth investors, where Indian or foreign, for investing in accordance with a defined investment policy for the benefit of the investor. So, that is a alternate investment fund basically for those who have surplus funds in huge amount and they invest for this particular purpose, and there is an interest rate may be vary here according to the demand and supply policy. The Securities and Exchange Board of India has notified the Alternate Investment Funds Regulation 2012, and this resolution notified on 21st May 2012 for regulating private pools of capital or alternative investment funds. Venture capital is another form where generally equity investments made by venture capital funds at an early stage in privately held companies having potential to provide a high rate of return on their investment. So, venture capital basically when two or more than two corporate entities agree to invest their funds for particular project, that is known as venture capital. It is a resource for supporting innovation, new ideas, knowledge based ideas and technology and human capital intensive enterprises. When you start a new innovative idea, sometimes funds are not available for such ideas. They are funds provided by venture capitalists according to the demand of the time. So, this fund is known as venture capital fund and they are supporting some ideas here basically, and that's maybe a innovative idea, maybe a new idea, that's knowledge based idea or technology based idea. So, various aspects here open through this venture capital fund. Bank finance, Banking Regulation Act 1949 classify bank finance into secured loans and unsecured loans. Secured loans as usual means loans granted by the banks on the backing of some tangible security, while unsecured loan not backing with the same. It means banker has rely on the personal security. Where there is an tangible security, that is a secured loan. Where there is a personal security, that is an unsecured loan. basic criteria to differentiate between these two loans. A letter of credit is a new type of instruments, and that's document from a bank that guarantees payment. It is an undertaking commitment by the bank advising informing the beneficiary that the documents under a letter of credit would be honored if the beneficiary submits all the required documents as per the terms and condition. So, this document basically letter of credit always issued by those who have the strong credit in the market, and generally this feature enjoyed by the banks and financial institution. Their credit is very high in the market. Bank guarantee is also one of the instrument who serve the purpose of corporate finance, or that is also serve the feature of a instrument. That is the part of non-fund based credit facilities provided by the bank to the customers. Bank issue bank guarantee on behalf of his client as a commitment to third party, assuring him to honor the claim against the guarantee in the event of non-performance by the bank's customer. So, bank guarantee basically a document which become operative when customers fail to convey, fail to perform their promise, fail to pay the amount as assured by the agreement. So, in this direction that is also used as an instrument. Foreign funding, the Government of India has taken various policies, initiatives to allow Indian companies to raise funds from international market. These policy initiatives have led to introduction of international instruments like ADR, American Depository Receipt, GDR, Global Depository Receipt, and foreign currency convertible bonds and foreign currency exchangeable bonds and through external commercial borrowings. These are the instruments which issue by foreign issuers or the Indian issuers to attract the foreign investors accordingly. If foreign investors issue the security, they issue in the form of IDR. When Indian company issue the security, they issue in the form of ADR or GDR. International instruments depositories issue as per the terms and condition defined in Depository Receipt Scheme 2014. The issuance of depository receipt is one of the mechanism used by Indian companies to get an access to foreign investors. In very simple terms, depository receipt is a foreign currency denominated instrument which is issued by overseas depositories to non-resident against securities of the Indian company. So, these particular receipts attract the investors in the market. American Depository Receipt, ADR and Global Depository Receipts also some basic purpose here. ADR means a security issued by a bank or a depository in United States against underlying rupee shares of a company incorporated in India. ADR are denominated in US dollars and traded only in US. Global Depository Receipt means a security issued by a bank or a depository outside India against underlying rupee shares of a company incorporated in India. GDRs are traded in various places as New York Stock Exchange, London Stock Exchange or other exchanges, etc. Foreign currency convertible bonds are optionally convertible bonds issued in currency other than in Indian rupees. This is enjoy the both features. Convertible bond is a mix of both debt and equity. Unless and until you convert in the securities, they enjoy the debt instrument feature. Once you decide to convert this instrument in the equity instruments, then they are treated as investment. So, interest and redemption price conversion option is not exercised, is payable in dollars. That is based on contingent conditions. It means that is happening on some conditions. If you exercise this option, these features are available. If you exercise the another option, the another features are available. Foreign currency exchangeable bonds. Indian promoters can now raise money from abroad by issuing foreign currency bonds, and they also enjoy some important features here. Issue of foreign currency exchangeable bonds are governed by Foreign Currency Exchangeable Bond Scheme 2008, issued by Ministry of Finance, Department of Economic Affairs. ECB is also one of the instrument. This is a external commercial borrowings, that's loan raised by eligible resident entities from recognized non-resident entities and should conform to parameters such as minimum maturity, permitted and non-permitted, and uses, maximum, all-in cost ceiling, etc. So, various features are available in external commercial borrowings. Foreign direct investment is also one of the way to attract the foreign investors, and these foreign direct investment allowed through two ways. One is automatic route, where entry route through which investment by a person resident outside India does not require the prior approval of the Reserve Bank of India or other regulators. Government route means where you first take the approval from the regulators. Foreign portfolio investment means any investment made by a person resident outside India through capital instruments where such investment is less than 10% of the post issue paid up share capital on a fully diluted basis of a listed Indian company, or less than 10% of the paid up value of each series of capital instrument of a listed Indian company. So, there is the two situations you are allowed to be apply up to the 10% in such cases. Securitized assets is the transformation of financial assets into securities. Securitization is a technique used to convert non-liquid assets claims to tradable securities, and SEBI notified time to time the rules for these instruments. Issue and listing of securitized debt instruments and security receipts regulation 2008 issued by SEBI for this particular purpose, and the market needs basically decide here with this regulation, and competition policy and professional expertise of credit rating agencies, disclosure obligation of the parties involved in the transaction. So, every transaction required some parameters. If you fulfill these parameters, every instrument designated categorized as a valid instruments. If you not fulfill these parameters, your instruments not treated as a valid instrument. Loan against securities. Bank and financial institutions generally provide loan against the securities, and this loan against securities advanced to a customer against the pledge of a securities, or simply put loan against insurance policy, mutual funds, NSC or other securities. So, there is the various ways. Loan against property is also one of the form where bank grant against property loan to the prospective borrowers. Bank take the authority of property in their own hand, and against this authority they provide the loan. After due appraisal, banks sanction generally anywhere between the margin set by the banks and the value of the borrower's property. Bank decides generally how much loan here granted against this property. So, we are here on summarized part of this entire discussion. Financial instruments play a very important role in global capital market, offering diverse avenues for funding and investment. Indian corporate financing basically landscape has evolved with global integration as seen in instruments like ADRs, GDRs, FCCB. These are in the lining of international securities. The regulatory framework including SEBI guidelines, central government guidelines, RBI guidelines, these guidelines basically for establish the confidence of investors in this market. And once a confidence established of the investor in the market, they never hesitate to provide their hard savings for these industries. In nutshell, that is a dynamic nature of financial instruments coupled with regulatory safeguards and global integration contributes to a robust and innovative corporate finance environment in India. Thank you.
Hello and welcome to this piece of literary snippet. Perhaps the most popular literary genre after novel is the short story. Sharp, compact narratives whose charm lies not only in what is said but also in what remains unsaid. Today I'll be reading one of the shortest instances of a short story that I have ever encountered, and indeed the very charm of this particular story that I'm going to read out today lies in the way it abruptly ends. It is an ancient tale from Mesopotamia which has been retold by several authors, among whom the name of Somerset Maugham stands out. The adaptation that I'll be reading out is perhaps the closest to the one that Maugham wrote. The story is titled, in all of its adaptations almost, as Appointment in Samarra. Here is the story. A merchant in Baghdad once sent one of his servants to the market. The servant was supposed to buy provisions for the merchant, but when he returned, he came back empty-handed. Indeed, the servant had all gone white, and trembling with fear, he told his master that he had met death in the marketplace. When I entered the market, the servant said to his master, I was jostled by a woman, and when I turned to look at her, I saw that she was death. I am very scared, master, because death looked at me with a threatening gesture. Can you please lend me your horse so that I can fly away from Baghdad to the town of Samarra and thereby escape death? The master, being a good man, gave his servant his best horse and saw him gallop off to Samarra to escape death. Then the master himself went to the marketplace and confronted death. Why did you make a threatening gesture to my servant? Asked the master to Death. And Death replied, it was not a threatening gesture. Rather, it was a start of surprise. I was astonished to see your servant here today, because this evening I have an appointment with him in Samara. See you in the next episode of Literary Snippet.